Chris D here, head systems trader at MacroOps, and I want to start out with first saying subscribe, like these videos. If you subscribe, you can get notified when I put videos out that are actually relevant and timely. This one is not, but do like and subscribe. You can go to my website, christopher.com, get on my email list. I'm starting a newsletter as well. Don't forget to follow me on the Twitters, at Christy Macro on Twitter. That's where I do most of my stuff throughout the day. Okay, so today's question, or what I got the most requests for to talk about, and I've been getting this quite a bit. So I've been day trading Russell 2000 futures pretty regularly for the last couple of weeks, and I've just been sharing my entire day trading. You know, this is where I'm in, this is where my stops are, I'm adding, I'm exiting, and all that. And I did a whole video on that. You can go check that out if you're interested in the way I trade it. But the questions that I was getting asked today is, why do I choose? First of all, why do I trade the Russell 2000? And second, how do I choose which ones I'm going to trade? So I'm going to go through right now and show you a little trick I have. First of all, I'm going to get into why I trade the Russell. And the only reason I trade the Russell is because currently we are in a bull quiet market regime on the Russell. And typically what happens in that environment is that dips get bought, and even the best, most beautiful short setups fail, or they just are not consistently good, where your long positions are way more consistently good. So I have an indicator on that I share on TradingView for free. It's called the SQN. You can just look for SQN Christy. There's two of them in there: Christy Fallible, Christy Macro. Both of them work. It's the same code, and what it does is it just measures the change price from open to close of the last 100 trading days, and then it does a standard deviation of that, and it starts to come up with, okay, what are we at? Where are we at? You know, for the last 100 days on, let's say on the S&P, overall the standard deviation is 1.4. So the change is 1.4% day over day. I just got back from a run, so I'm a little congested here apparently. So then what I did is I go through and I just have this SQN indicator across all the different charts that I would be looking to day trade. So we have the S&P, we have the Dow, we have the NASDAQ, we have the Russell. Here we have bonds. You can see that one's negative. So we just generally speaking, we'd be looking to go on the short side instead of long. We have crude. That's a bull quiet, so day trading there. Natty gas is pretty flat. That just says it's more of it's a neutral market, so you're looking for really short-term trades, mean reversion. And we just moved into bull quiet on gold. So in this case, when I have green or olive color, that is bull quiet, okay? So I'm looking to only get long or trade other strategies that I know work during that bull quiet regime. That's the thing. So when it's categorizing the market type too. If we're in bull quiet, then bull quiet, we buy dips. In bull volatile, which is this blue area, that's typically where we get market tops, and we get big moves up and down. So we start getting 2% moves here, 2% moves there, and you can change the course of a couple of days, go down 2%, up 2%. So things start to get a little toppy in that sort of environment. We move back into bull quiet here for now, though it might seem like we are in kind of a bull volatile move on NASDAQ, Dow, and S&P. However, Russell is just kicking around right there, still got plenty of room to go in the bull quiet. Coming over here to oil, we just got into bull quiet. I'm long, and I'm holding a long position in crude. I'm not day trading it. I just got into a position in natural gas, and that would be one thing I know about the neutral regime is it's going to bounce up and down and go sideways most of the time. So I'll be trading a mean reversion strategy when we're looking at, I'm sorry, this was gold just got into a buy. So I'm starting to build my long position there, not day trading it. Crude, it's long. It's fairly obvious we're in a bull quiet regime. So we've broken out of a lot of sideways moves, and it's starting to trend higher. So I do have a long position there. And as far as bonds go, we're in bear quiet to bear volatile, kind of just bouncing around there. So that's not enough to capitulate a bottom. That's enough to say we could get going here, or we could just kind of drift. So I have all these different ideas of how to trade the different market regime, which means you need to have a bull quiet, a bull volatile, a neutral, a bear quiet, and a bear volatile strategy if you want to trade all the assets all the time. Or you can simply have one setup, one trade, which is the way that I suggest, especially if you're starting out or if you're getting into this stuff. Just get into the easiest one to trade, which is a bull quiet regime. It makes the most money. It causes the least headaches. Sure, you have some stops. It's not 100%. You can have 60, 70% win rate, 80% win rate in there. But when you are making money, you can catch some good runners in there. It's not mean reversion trading. It's very trend trading. So for me, I like to look for weakness on the open to buy it and then kind of trade it throughout the day. I like to get long any weakness in a bull quiet regime. So if I was wondering, okay, now why do you trade the you have the S&Ps in bull quiet, Dow's in bull quiet, the Nasdaq's in bull quiet. Why are you trading the Russell so much? Well, if you see, these have really moved quickly into bull volatile terrain up there, whereas Russell still has some good space in the bull quiet. And you can see when I started trading it more prominently on Twitter, we were just getting into that space, whereas the Nasdaq had already flirted with it, and these have already been in there for a little bit. So what does that mean to me is I got more opportunity for time. Also, if you're to look at the difference between the Russell, Nasdaq, S&P, and Dow on a daily chart, you can see that all the other three have been hitting new highs consistently. We still haven't put in a all-time high on the Russell. So that just means that either it's going to lag to catch up, and in my mind, that means that there's going to be more opportunity to catch those trades, or it's just an easier thing to trade as well. So statistically, the S&P provides the worst returns. Now, this is my statistics in my work, but the podcast that Darren and I did, we talked about that. We talked about why people think that they need to be a S&P trader or an Apple trader, or they like to put their name behind a certain asset that they trade where there's no real reason to do it. We have thousands of different assets to trade. We trade 24 hours a day, 5 days a week, 7 days a week if you're trading crypto. Like, you don't have to be defined by the actual asset you trade. I mean, occasionally people think I'm a Russell trader, but sure, I don't care. I'm also in crude. I'm also in gold. I'm also in silver. I trade currencies like crazy. I actually do far more swing trading, end of day trading, than I do day trading. But when we are in a good environment for day trading like we are right now, I like to focus on that. So I'll pull this up and I'll just say, okay, what am I looking at trading today at the beginning of the day? And I'll go through it and I'll just be like, okay, well, I'm in a position on crude. So even though we're in a bull quiet there, I don't need to look to day trade that. I can look to add to positions there. I'll monitor it. Same with gold. The bigger ones here, maybe the Dow. Looks like there might be some opportunity to trade that there. But as far as the S&P and Nasdaq, that's going to be a lot more volatile, and it's not going to trade my trading strategy that I'm focused on at the moment, as well as this. So if these were all bull volatile, I would move to a day trading bull volatile strategy. If they were all bear quiet or neutral, I would be looking at a day trading neutral intraday mean reversion type strategy. So identify a market type. I suggest bull quiet, and then go through and find the different assets and see what ones are in a bull quiet, because that's the easiest. And also, when you're in a bull quiet, this is where you start getting the angry people on Twitter talking about the Fed doing this and market manipulation and all this other, they're not going to let this dip or drop, and it's held up on whatever angry bear thing that they're going to be yelling into Twitter while the market's going higher. You can be angry at things, but you need to look at reality. And statistically speaking, this is price action. this is statistically speaking, this provides an edge. I want to be on the winning side of that edge instead of being angry and trying to catch a losing trade that I have to get stopped out on over and over and over just to be right that one time. Because trying to be right that one time, I got to tell you, everybody I know who's tried to be right and catch the top gives money back nonstop, and they eventually catch the top and maybe get short, and they hold on to their shorts far too long. Maybe they were short back in the end of 2018 when the market was just down about 20%, and they're adding to their shorts. They're thinking this is the big one. We're going down 40, 60, 80% in the market, only to see it turn and hit up new all-time highs. So use logic, which is not what is a well-presented case and story by somebody who is very charismatic or has a lot of followers or can yell the loudest. Logic is evidence-based, and that's real logic, evidence-based. And what we have here is evidence-based edge and advantage of characteristics of a certain market regime. And then go find setups out there that work, that are long-only setups, long-only intraday setups that are very, very simple. That's all you need to focus on. You can go look at a double bottom. You can look at buying bull flag breakouts. Very simple price action. Very simple strategies to day trade that. Now, this is fractal, so it works on all time frames, those sort of things. But the reason I do this on a daily is because I'm looking at the longer term picture to inform what the average is going to be over the previous 100 days, and it's going to continue to, like, I know what the pattern's that's going to give me some room to play out over time. Now, the next thing the last point I want to cover here is simply because it says bull quiet and bear quiet doesn't mean that bear quiet trades the opposite of a bull quiet. So, for instance, you wouldn't just go over to the bonds and say, okay, well, I'm looking for double tops and bear flags to go short on pullbacks, because bearish markets trade differently than bull markets. Markets generally have participants who are conditioned to buy. The vast majority of people are conditioned to buy, so the short sellers are always fighting that constant bid. So when it goes down, down moves go fast, and they don't go as far and they don't last as long as bullish moves do. So when you're thinking of catching big runners to the downside and thinking you're going to go do bonds and trade it the same opposite way I am trading the Russell, you're going to get smoked. Because each of the 5 different market regimes, and you can categorize them however you like, you can come up with your own strategies on them, but each of those 5 different regimes trades completely differently. And it's your job to figure out strategies for each market regime, or figure out strategies for one market regime and then just go have a universe of 50 or 100 different assets that trade that market that are trading in that market regime for you to trade. Okay, so I got that here. Now I go to, let's say I'm gonna go trade the Russell. So one thing I like to do when I'm trading the Russell is I like to have my daily up. So you can see I'm aware that it is a bull quiet regime. So we got some good selling here. I'm gonna be paying attention to maybe the potential of a reversal tomorrow. And if it doesn't, then this would be time to take some profits in the market. Anyway, that's my daily. I keep that there. I can always just do this so that it reminds me completely and I don't have to like get caught up in a daily move while I'm day trading. And then I like to keep either a 30 or a 60-minute open so I can pay attention to what's going on. Sometimes even a 240. It's really, it's just kind of what I want to. I just want to get the bigger intraday picture, like the shorter term picture of what's going on. So we're going down, and then I have, so here's a 20-minute chart. I'll trade 20 minutes, I trade 5 minutes. It doesn't really matter the time frame. You just know that if you're trading 5 minutes, that you have to make a decision every 5 minutes. And if you trade a 20-minute, you have every 20 minutes to make a trade. And also what happens during those time frames when you're getting those sort of moves, things are constantly happening. And so you got to pay attention. If you're doing a 20-minute, then your stops are they're going to be a lot bigger. It's going to take a lot more time to get to your targets. Anyway, like and subscribe, everybody. Ring that bell. You'll get emails notifying you when I post stuff. Comment down below. Comment on YouTube. Hit me up if you have questions. This is kind of just a precursor or a help to for you, so that you can go down that path. And I'm providing this. Yeah, I provide this stuff free. I do sell courses. They're on my site, christover.com. If you're looking to go further down the rabbit hole and learn that stuff, but if you're the sort of person who just wants to take this stuff and run with it and learn there, hey, that's why I do it. I share this stuff for free. I kind of piecemeal it here and there. The courses have it all laid out, how to build a system, how to categorize markets, all that sort of stuff. But I still share this stuff openly, and it's I love it. I love working with everybody, and happy trading, everyone.